So, Coinbase just dropped its latest earnings report, and wow, at first glance, the numbers look incredible. But once you peel back even just one layer, you find a much more complicated story. A story that's not just about one company, but about these huge shifts happening in the entire world of finance. So, is Coinbase about to become the everything exchange for real? Or are there some serious red flags we need to talk about? Okay, let's get into it.
Okay, so this is the number that was splashed all over the headlines. For the second quarter of 2025, Coinbase reported a net income of $1.4 billion. I mean, that is a massive figure for any company, let alone one in the super volatile crypto space. A huge win, right? Well, maybe not.
Because here's the head-scratcher. Even with that eye-popping profit number, the company's stock actually went down after the news broke. So that's the big puzzle we're going to solve in this explainer. What did Wall Street see that wasn't in that billion-dollar headline?
All right, so to figure this out, we've got to pop the hood on that massive profit number and see what's really going on under there.
And right away, here's our first huge clue. You see, the official by-the-book net income was that stunning $1.4 billion. But then you look at what Coinbase calls its adjusted net income, and that's just $33 million. I mean, that is a gigantic difference. So what exactly are they adjusting for?
Well, think of it this way. Adjusted net income is supposed to show you how the actual core business is performing. You know, the money they make from people like you and me trading crypto. It's designed to strip out all the one-time financial events, like the value of their investments going up or down. It's meant to give you a cleaner signal of the company's real health, separate from all the market noise. And bingo, there's our answer. That massive billion-dollar profit didn't come from a huge boom in people trading on their platform. Nope, it came almost entirely from paper gains. They had a $1.5 billion gain from investments, like their piece of the company Circle, plus another $362 million from their own crypto stash going up in value. These windfalls completely hid the fact that their main business was actually having a really tough time. But here's the thing. To really get Coinbase, you can't just look at one quarter's numbers. You have to understand the absolutely massive, incredibly ambitious vision that CEO Brian Armstrong is pitching to the world.
He calls it the everything exchange. And the vision is as simple as it is huge. Create one single platform where you can trade, well, everything. Stocks, real estate, art, crypto, you name it. All of it turned into digital tokens, all of it running on the global network of the blockchain. And look, this isn't just some vague dream. They have a concrete three-step plan to get there. First, plug into decentralized exchanges so they can offer millions of different crypto tokens. Second, build out a huge global derivatives business for the pros. And third, the real holy grail, launch tokenized stocks and bring the entire stock market onto the blockchain.
Now, to power all this for other big companies, they've got a killer playbook. They're building something they call crypto as a service, and Armstrong himself says they're modeling it directly on Amazon Web Services. You know how Amazon built all this incredible computing infrastructure for itself and then started renting it out to everyone else? Coinbase wants to do the exact same thing, but for crypto.
And you know what? It seems to be working. I mean, just look at this lineup of partners. We're not talking about little crypto startups here. These are the heavy hitters of finance and tech: BlackRock, JP Morgan, Stripe, PayPal. All of them are using Coinbase's technology to build their own crypto products. That is a massive stamp of approval.
Okay, so that's the super bullish grand vision. But it still doesn't explain why the stock dropped. To get that, we need a little reality check, and it comes from a financial analyst who's watching all of this very, very closely.
One analyst had this fantastic analogy. He said, exposure to crypto is good to have, but it's like chocolate. You don't want to have too much of it. You get too much of it, you get sick. His point is that for a lot of investors, a company that is 100% crypto, like Coinbase, might just be too much chocolate. A more diversified company, like Robinhood, might be an easier way to get a taste.
And this same analyst raises a really sharp question about that whole everything exchange idea. Is this push into stocks truly innovative? Or is it just a Me Too strategy, basically playing catch-up with companies like Robinhood who have been in the stock trading game for years? It's a fair challenge to their grand plan.
And here's the cold, hard data that backs up that skepticism. If you ignore all those paper gains, Coinbase's main business, the money it makes from trading fees, took a nosedive. It fell from over $1.2 billion in the first quarter all the way down to $764 million in the second. That's a drop of almost 40% in just 3 months. That's a flashing red light.
So we've got the bull case and we've got the bear case. But here's what's so interesting. There's one area where both sides, the bulls and the bears, see a future that is just undeniably huge. And that thing is tokenization.
But the analyst makes this really smart distinction. Tokenizing a share of Apple stock for an American investor, he's not sure what problem that really solves, since trading's already basically free. The real opportunity, what he calls a massive leap, is tokenizing the things that are hard to get right now. Imagine being able to buy a small piece of a private company like Stripe, or giving an investor in another country easy access to U.S. stocks for the first time. That's the game changer. And get this, for all the headlines it gets, just buying and selling Bitcoin, what we call spot trading, that's only a quarter of the entire crypto market. The other 75%, that's all derivatives, things like futures and options. This chart shows you exactly why Coinbase's push into the derivatives market is so important. Right now, their main business is fighting over the smallest piece of the pie.
So, what could finally tip the scales? For years, the biggest question mark hanging over all of crypto has been regulation. And just recently, it feels like the clouds are finally starting to part, showing a much clearer path forward.
The momentum here has just been stunning. Seriously, for years the industry was begging for clear rules, and then in just the last few months, they've gotten a tidal wave. Coinbase got a major license for all of Europe. Here in the US, major laws for stablecoins and market structure flew through Congress. Even the SEC is now talking about a new path to getting a single license. After a long crypto winter, the regulatory winds have definitely shifted.
Okay, let's put a bow on all this. What's the big picture? First, that headline profit was a bit of an illusion. It was driven by investment gains that hit a rough quarter for the main business. Second, the Everything Exchange is an amazing vision, but it's facing some real Me Too skepticism. Third, the trends nobody can deny are the tokenization of everything and a huge improvement in regulatory clarity. And finally, the key battle for Coinbase from here on out is winning market share in derivatives and institutional services. Which leaves us with the ultimate question. Because really, Coinbase's success or failure is just a bet on a much, much bigger idea. It's a bet on a future where every single asset we own, our stocks, our house, maybe even our bank account, is tokenized and lives on a global, decentralized network. Is that the future of finance? Well, that's the multi-trillion-dollar question.